Hey, how are you doing?
Hey, Leslie.
A
Doing great.
quick introduction, and I know a lot of people know because, people that watch these videos, actually, most of them probably know, but this is Two Mullins with My Mortgage. I say it, is it My Mortgage?
My mortgage.
All right. I'm always afraid of pronouncing it wrong. So, My Mortgage. And of course, I'm Lesley Vitel with Keller Williams Realty. And we just wanted to do a quick video because we've got some exciting news about Hometown Heroes. So, tell us
That
what's going on.
is it. June is over as of today, and July is here. And so that means we've got Hometown Heroes coming back 3.0 this year.
Yay.
So the third summer in a row. Funds made available from the Florida Housing Corporation for buyers anywhere in the state. Doesn't matter north or south, as long as the property is located in Florida and you're a first-time home buyer or a military buyer, a VA buyer specifically. You don't have to be a first-time buyer, but there's money to help. The biggest thing it helps with really is the out-of-pocket cost, the reduction of out-of-pocket expense, just making it a lot easier to help someone get into their first home or move up home, like we said, for veterans. So it's back, and we should talk about that a little bit. There's a lot of cool key details of who it helps, and how much you can
Yeah.
get. And yeah, I'm
So
pumped.
let's start with who, because it's not for everybody necessarily. So
Right.
let's start with who it helps.
It's got to be first-time buyers, someone who intends to live in the home as their primary residence. So not an investor, not a second home. It's got to be everyday home, and it's got to
But could it
be.
be up to 4 units? If
It
I found
can.
somebody a fourplex.
It definitely can, but they've got to live in one,
Okay.
and they've got to be calling it home. So that's the who and that's the what. It can be a duplex, a triplex, or a quadplex, but it just has to be their primary residence.
Okay. And they have to
Um,
be residents of Florida. Now,
right.
1.0, it mattered what you did for a living. Now it doesn't.
And not so much. Yeah, it mattered what you did. It mattered if, what your occupation was. Here it doesn't. You just have to work for a Florida-based business, which means that you have a location here in the state, and it can be anywhere in the state that you report to and that your employer would have to vouch for that you report to that. Even if you work remote, if I work, remotely in Jacksonville for my company, but we have an office in Jacksonville that I can report to or someplace else, then you're qualified. The only
Okay, but
folks
that
that
is an important distinction because I do have people. I've got a guy this, at the beginning of the year, he was going to be telecommuting from his office, but his office is in Nashville. He would not qualify for these funds.
That's correct.
Okay.
Even if he's living here, he'd have to have a branch or some location within the state that he could call his branch and that his employer
Okay.
would stop on.
Okay.
Yeah, that's a key ingredient. But it can also mean self-employed buyers as well. If you own your business here, the same applies. If your business is based in Florida and you are a full-time worker, or if you're employed, your employer has to vouch that you're a full-time worker. One of the changes this year is that the definition full-time means whatever your employer considers full-time. In years previous, it meant 35 hours. We quantified it. This year, it's the state's allowing the employer to designate whether the worker is full-time. If you're not full-time, like for example, part-time, then it wouldn't
Mhm.
qualify either.
So
So
your
that's
gig workers, it's really not going to qualify. Like
correct.
if you're a full-time Uber driver, this is not going to be a program for you. There's other programs. This is not the program.
This would not be the program. Maybe you could get technical there depending on how someone had their business structured, and maybe there was something there. But the idea is a Florida-based business, a place that has a brick and mortar that you can go to, and that's your place of business. And that's a lot of folks. So part of the thing is it does come with a bit of urgency because in years past, when the funds were available only to specific professions, it lasted a lot longer. Last year, this changed and it was open to any first-time buyers again, and military and prior military, and the funds only lasted 3 months versus 12 months the year before. So that
Wow, that's huge.
yes,
Huge. So we're
uh,
looking at, if you're looking at using these funds as of July 1st, you've got until basically October 1st.
yeah, I would plan like to really use them over the next 3 to 4 months,
Okay.
sooner than later. So anyone that's in the market now, or maybe if you've just recently gone even under contract, this would still apply to you. We can start reserving the funds as early as tomorrow.
Good to know. Yeah, and
Yes.
I didn't want to be negative about, if you're driving Ubers or whatever, like I just kind of comprehending,
Sure.
because a lot of people work a lot of different ways, but this does still
Yes.
cover the vast majority of full-time employed people in our state.
Oh, for sure.
Yeah.
Yeah. Brick and mortar workers, W-2 or self-employed buyers. So that's a part of it. We said it's got to be a primary residence, any occupation, as long as you have a brick and mortar place that you do business and that you're a first-time buyer, which means that you haven't owned a home within the last 3 years. The only exception to that rule is our VA buyers, active duty and prior military. You do not need to be a first-time buyer. So, I mean, without question, just having the flexibility that VA already offers, added benefit from some resources to help with down payment and closing costs goes a long way.
Yeah, no, that's massive. I love it. All right.
Yeah.
And when we say it goes a long way, what exactly is it? What does it help you with?
So it helps with the out-of-pocket expense. The state basically what they allow us to do is reserve a portion of money equal to 5% of the loan amount. So for example, if someone purchases and they borrow a loan, they take a mortgage out for $300,000, that makes them eligible for $15,000 that we can use towards a minimal down payment. Oftentimes that's enough to cover your minimal down payment, which is great because the remainder of the money can be used towards closing costs. So considering that the buyer oftentimes, almost always, is have some binder deposit, they're going to have a little out of pocket expense with for an appraisal with the lender. Those are credits, and along with the remaining money, oftentimes is enough to set the buyer up to where they're having to bring a very small amount to cover the rest, and sometimes even bringing zero, bringing no money to close, just depending on how much the deposit was and any other credits that they may have as well.
That's fantastic. I love it. And so, and your maximum amount. So it's 5% of the loan amount up to
5% of the loan amount up to $35,000. That's the maximum that we can reserve. That goes a long way if you've got someone
yeah.
purchasing at a higher price point and borrowing 600K plus or even 700K plus. They're still eligible for this. The maximum loan amount $726,600
That's
for
amazing.
a family home. So yeah, it definitely goes a long way.
Yeah, absolutely. And how does this get set up? Because this is set up as it is a lien on the property, like it gets paid back, but it gets paid back when you sell the house, correct?
Correct. Yeah. So the funds that we reserve and that are used, they're recorded as a secondary mortgage. So as a second, with 0% interest with no monthly payment. So you never have to make payments against it monthly, but you do have to pay it back, and you have to pay it back, under a few different circumstances. One is if you ever sell the home.
Mhm.
And that can really be at any time. It can be, a year and a half after you purchase it, or it can be 15 years after you purchase it. But at that time, if you have the original loan set up the way you had it at closing, it would be due at that time, along with any other balance that you have on the primary mortgage.
All right.
So, in theory, the way I like to think of it is, the home being, going to appreciate over time. You're making payments against your mortgage, which decreases over time. It gives you the opportunity to use the equity money long term to then pay it off. So, in effect, deferring the down payment until that time, and paying it off then. Another instance where you have to pay it off would be if you're structured otherwise, if you ever,
You you cut out a little bit.
the
You did.
thought that
Wait, you cut out a little bit. Say that again. The other instance of when you have to pay it back.
another would be if you ever restructure the loan at all with a refinance. So
Okay,
maybe
that was going to be my
you
next
go
question.
Yeah, if we go down the road to take advantage of better times, better interest rates, or if the buyer has to restructure for any other reason to take cash out, or if they want to take a shorter term, pay the loan off sooner, we'd have to combine it then and pay it off. And that's been really popular over the past several years as rates decreased. We did a lot of that, during 2020, 2021, and 22, while rates were still lower.
Mhm.
Or, people had used loans similar to this in 2016 or 2017. And a good time came along where the market had improved. Maybe we could even change the program, for example, from an FHA to a conventional with a higher value, get rid of mortgage insurance, reduce the rate, and save some money, long term, that was still offering a way for people to save more money down the road and paying off the second that they had originally taken out.
Okay, fair enough. But that is definitely an interesting point, as we are, and I don't know that I love the saying, but we know why people are using it. The marry the house, date the rate. This does factor into that, and it does matter. You just want to make sure that you just want to make sure that everybody's aware of that.
Right, that can be a part of the long-term plan. You know, it's a wait and see, obviously, with the market and when that would be, but it's a conversation that you can have down the road, and it's not something that you have to miss out on because you have it, and you could still improve with the market if it's there.
Yeah, and our market's still growing. We're definitely still seeing equity. People are building equity. We're in that really comfortable position right now. The market is shifting a little bit, but it's definitely not shifting into anything negative. It's shifting out of the crazy and into something a little more normal and a little more
Right.
of a normal pace.
Yeah, definitely a lot of demand, definitely a lot of folks still coming here. I'm glad this program is coming out because it will help with that. There's, it's a really healthy market. There are plenty of sales going around. This really helps reduce the biggest barrier, which is oftentimes it's always out-of-pocket expense. It's the down payment, the 3%,
Yeah.
3.5%, the closing costs. So this is a really good tool to help fight that, to help fight against inflation, to help people keep more money in their pockets, or maybe use the funds to combine it with money they've already got to make a more impactful down payment. So they're borrowing less and taking a smaller loan out and having a lower payment monthly. So a lot of ways to fit it into whatever the plan is.
Yeah, that's huge. I love it. I love it. And we're talking about, and you and I talked earlier, when we talk about the fact that you have to be a first-time home buyer unless you're VA. If you've got somebody in your universe that that isn't necessarily a first-time home buyer, this is where working with an experienced mortgage professional matters, because you can get creative. And I know you were giving me a really good example of how you got creative to help get somebody into this, where one of the people buying the home that was going to be living in the home was not a first-time home buyer. So talk a little bit about that.
Correct. So there's flexibility that's there to help. The goal of the program is to help first-time buyers secure a home that they are no longer renting and that they can, start to build equity from. So, understanding where the market's at, co-borrowers are allowed. There's a segment of the loans for Hometown Heroes where we can use a co-signer if someone's income isn't quite there, maybe to purchase the price that they need to, but maybe their significant other isn't a first-time buyer. So how can we still look at this person and say we can qualify them for their first home? There's opportunities to do that with co-borrowers. However, who it is really matters. And just to explain co-borrower, that would just be meaning that someone's purchasing the home without the intentions on living there as their primary residence. And that's one of the requirements. That's nice because that means that if I want, for example, maybe if I need to use a parent or a family member or a grandparent or someone else along those lines who's not a first-time buyer, I can still purchase as a first-time buyer and take advantage of that, using the income to then make up for maybe what I wouldn't have been able to qualify on my own.
That's amazing. I mean, that's such a nice little way to get people in. And I know we often see people, multi-generational people, parents and grandparents, wanting to help kids get into their first home to get started off right in life. And so this is a really good way to go about doing that. It sounds
Definitely a good way to help do that and create a home buyer maybe where we wouldn't have had one. So awesome.
Yeah, I love it.
Yes.
Well, that is awesome. We're excited that that's back, but we need to get on it fast.
Yes. Got to get on it fast. There's a lot of, part of the demand around it is because, the state helps with the out-of-pocket expense. They give a few other benefits as well. The cost structure for the loan, closing costs. We talk about down payment a lot, but when you buy, there's down payment, there's also closing costs. This program in particular helps with that as well. The way it does that is it helps eliminate some of the closing costs. The state lets us waive some ordinary expenses that you would incur otherwise anytime you're buying a home. For example, doc stamps. That's a tax that you pay on a mortgage if you take one out in the state. That's waived. So $0 for that.
Really?
For this program. Yes. The intangible tax. That's a tax that you would pay on any loan you take out. A student loan, a personal loan, a car loan, a mortgage. You have to pay that to the state. That's also waived with this program. So that's an opportunity to save on the cost structure.
Those are
Another,
two of the, other than loan costs, those are two of the biggest costs getting into a property. I mean, that's massive.
yes, yeah, the state sees it as a way to use funds to help with the purchase. Why then tax? So therefore they're waived. It lessens the
That's
burden
amazing.
for the buyer and helps that money then go a little bit further in other ways towards down
Yeah.
paying actual closing costs.
And that doesn't get rolled up. That's not, that it cost isn't deferred. That is waived.
That is waived, yes,
Okay.
$0 otherwise where it would have been assessed.
Right.
So that's great. Another savings method is that the loans are priced at par. There's no discount points. Typically, if you're purchasing and you're qualifying for any rate, almost at any place in the market, regardless of credit score right now, there's some cost associated with it in the form of points. Hometown Heroes is charging 0 points. So again, just helping use the funds that are available to go a little bit further towards more meaningful things like down payment.
Well, I mean, that's huge. That helping with that barrier to entry is just absolutely incredible. This is exciting. I'm
Yes.
excited to hear that it's back. I'm excited to see who gets to use it. It's always nice to see families that are first-time home buyers coming in and really having those barriers to entry into home ownership removed for them.
Yes, that's what it's all about. The qualifications really aren't too difficult to be available. Like we said, first time buyers has to be a primary residence. Credit score does matter. We have to have a mid-score minimum of 640. So not asking for too high of a bar, but just serviceable credit. And like we said, veterans exceptions not having to be first time buyers.
I love it. Well, that's awesome. All right. Well, now it's our job to get the word out so people know.
Yes, people know and should understand that the funds don't last long. The reason they don't is because there's many other down payment assistance programs available all year round. There's other programs available now from Florida Housing Corporation along with this one. But anyone that's purchasing right now, the benefits of this one are going to outweigh the benefits of any of the others. So it's silly not to use it. So everyone will. And that's why it won't last long. There are $100 million, but even with the market still having the activity levels that it does right now, we can expect it through the end of the summer. Let's hope, as long as possible through the summer, maybe into the early fall, but maybe not.
All right. Well, then I guess it's time we go get busy.
Yes. Let somebody know.
Love it. I love it. Well, thank you so much. I really appreciate it.
Good seeing you.
You
Thank you.
too.